All right, stop scrolling for a second, because something big just happened and most people are missing it. Last week, silver collapsed from about $121 to $72 in a matter of days. That's nearly 40% gone, fast. And here's the part that should make you pause. While traders were dumping paper contracts, the US was hosting a 50-nation critical minerals ministerial literally today, and at the same time, Donald Trump is pushing a $12 billion strategic minerals stockpile modeled after the Strategic Petroleum Reserve. Both governments and manufacturers just confirmed in different ways that silver is no longer just a trade. Stay with me because I'm going to show you why this matters right now and how you can spot this setup again before the crowd does. Before I explain what caused that violent drop, let me teach you something most people don't really understand about silver. You're not watching a normal supply and demand market. You're watching two markets pretending to be one. On one side, you've got paper silver, futures contracts traded with heavy leverage. On the other side, you've got physical silver, the stuff that actually gets delivered, refined, and used in electronics, energy, and defense. Think of it like a theater where millions of tickets are sold, but only a fraction of the seats exist. Prices move based on tickets changing hands, not on whether there are seats left. That works until it doesn't. And when governments start showing up asking how many seats are actually available, everything changes. So what does that tell us? It tells us that when you see silver move 40% in days, you're not just watching supply and demand adjust. You're watching one market liquidate while another market quietly accumulates. And that gap, that disconnect between what futures traders are doing and what physical buyers are doing, that's where the real story lives. Most people see the price drop and think the thesis broke. But if you understand the two market structure, you start asking different questions. You start asking, where did the selling pressure come from? Was it physical holders dumping metal, or was it leverage positions getting forced out? And then you ask, where's the physical going? Because if manufacturers are still buying and governments are still stockpiling while paper prices are crashing, that's not weakness. That's pressure building. Now here's what's actually happening, step by step. First, silver futures were heavily leveraged going into last week. You had traders positioned for upside, margins tight, and volatility already elevated. Then came the liquidation. Whether you want to call it engineered or mechanical, the result was the same. Margin requirements effectively forced selling. When silver broke key levels, stops triggered, contracts got dumped, and price cascaded lower from 121 to 72. That's the paper side doing what paper does. It reprices fast, it moves on emotion, and it amplifies in both directions. But here's the wild part. At the exact same time, physical markets didn't blink. Shanghai kept pricing silver at a $14 to $15 premium over Western prices. Manufacturers didn't cancel orders. Governments didn't step back. They stepped in. So when paper selling hit, physical demand quietly absorbed it. And that's why silver didn't stay down. We're already back near $90, up roughly 20% from the lows in just days. Now let me show you what most people are missing. This clash between margin-driven selling and strategic accumulation isn't noise. It's pressure building. Let me walk you through the mechanics of what happened, because this matters. When futures contracts are heavily leveraged, small price moves create massive position adjustments. It's not about fundamentals at that point. It's about survival. A trader who's leveraged 10 to 1 on silver futures doesn't have the luxury of waiting for the thesis to play out. If silver drops 5% and their margin call hits, they're selling whether they want to or not. And when enough traders hit that point at the same time, you get cascades. Price drops, margin calls trigger, forced selling pushes price lower, more margin calls trigger, more forced selling. It feeds on itself. That's what you saw from 121 to 72. That wasn't a fundamental repricing. That was a mechanical unwind. Now here's where it gets interesting. While that cascade was happening in paper markets, physical markets were operating in a completely different reality. Shanghai premiums, which tell you what buyers in China are willing to pay over Western spot prices, they stayed elevated. $14 to $15 over spot. That's significant. It means that even as paper traders were panicking and dumping contracts, physical buyers in the world's largest manufacturing economy were saying, we still want this metal and we're willing to pay a premium to get it. Mints didn't slow down. Delivery requests didn't decline. The physical world kept moving like the paper crash wasn't even happening. And that divergence, that's the signal most people miss. But here's the part that should make you pay attention. This isn't happening in isolation. You've got the US government hosting a 50-nation critical minerals ministerial. That's not a trade conference. That's a supply security summit. 50 nations getting together to talk about who controls the minerals that power everything from solar panels to missiles. And at the same time, you've got Trump pushing a $12 billion strategic stockpile specifically for critical minerals. That's the government saying out loud, we need to own physical supply, not paper contracts. When you combine that with manufacturers still buying during a 40% crash and Shanghai paying massive premiums, you start to see the real picture. Paper markets are resetting leverage, physical markets are tightening supply, and when those two forces collide, repricing doesn't happen slowly. Now let me show you what very few people are talking about. The reason this matters so much right now is timing. We're at a point where industrial demand for silver is no longer optional. Solar panel production, electric vehicle manufacturing, defense electronics, all of it requires silver in quantities that can't be easily substituted. At the same time, above-ground refined silver inventories relative to annual demand are at multi-decade lows. You've got rising consumption, flat to declining mine supply, and now you've got governments stepping in saying, we need strategic reserves. That's not a recipe for calm markets. That's a recipe for volatility with a bias toward scarcity. Zoom out for a second, because this isn't new. This is the exact same playbook we saw in 2011. Paper volatility spiked, prices smashed lower, sentiment broke, and then physical demand overwhelmed futures positioning. Silver didn't grind higher after that, it exploded. In April of 2011, silver was trading around $30. Leveraged futures positions were stretched. Then came the crash. Silver dropped from nearly $50 to $33 in a matter of days. Margin hikes, forced liquidation, cascading selling. Sound familiar? Everyone called it manipulation. Everyone said silver was done. But here's what happened next. Within months, physical demand absorbed the selling. Mints couldn't keep up with orders. Premiums expanded. And when silver turned, it didn't trickle higher. It ripped. By the time most people realized what was happening, the easy entry was gone. Same thing in March of 2020. Panic liquidation crushed everything, including silver, even as mints ran out of product and premiums blew out. I remember watching silver trade in the mid-teens while dealers were charging $5 to $7 premiums over spot, and telling customers we don't have inventory, we don't know when we'll get more. That's a broken market. That's paper saying one thing and physical saying something completely different. What followed wasn't immediate calm. It was repricing. Silver went from the mid-teens to nearly $30 in less than 6 months. Not because sentiment improved, because physical reality caught up to paper pricing. When supply becomes visibly tight, price follows, and it doesn't wait for consensus. Here's the pattern. Sharp downside volatility combined with rising physical premiums tends to mark transitions, not endings. Every time you see paper markets liquidate hard, while physical markets stay firm or tighten, you're watching the setup for a repricing event. It doesn't happen instantly. It takes weeks, sometimes months, but the signal is consistent. Paper resets first. Physical reality catches up fast once supply risk becomes visible, and right now, you're seeing the same signal. 40% crash in days, but Shanghai premiums holding at $14 to $15. Governments convening minerals summits. Strategic stockpile proposals moving forward. That's the pattern. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this all fade? Absolutely. Paper markets can stay disconnected longer than you expect. We've seen it before. Governments talk big and move slow. A mineral summit doesn't mean stockpile purchases start tomorrow, and not every price smash is a setup for upside. Sometimes leverage unwinds, markets reset, and prices chop sideways for months or years. That's possible here too. Here's the thing about manipulation claims. They don't help you unless you understand the mechanism. People love to say silver's manipulated, banks are suppressing it, it's all rigged. Maybe, maybe not. Honestly, it doesn't actually matter for your decision making. What matters is what you can observe and verify. Focus on the mechanics. Premiums. Are they rising or falling? Delivery stress. Are mints struggling or cruising? Policy signals. Are governments acting like this is strategic or speculative? Futures positioning. Is leverage building or unwinding? If those indicators fade, if premiums collapse, if governments go quiet, if industrial demand weakens, then the thesis weakens. Simple as that. But if those indicators stay elevated or intensify, then the risk shifts from price volatility to availability. And that's the distinction that actually matters. Could silver chop around the 80s and 90s for months? Yes. Could we see another flush lower if macro conditions deteriorate? Yes. Could this whole setup resolve with silver going sideways while gold or other assets take the spotlight? Absolutely. I'm not here to tell you silver's guaranteed to rip higher. I'm here to show you the pattern and let you decide what it means for your situation. What I will say is this. When you see physical tightness, government involvement, and industrial necessity converging at the same time paper markets are liquidating, that combination has historically resolved in favor of physical buyers, not paper sellers. It doesn't mean it happens fast. It means the probabilities shift. There are probably 3 types of people watching this right now. First, you're a trader and you're asking, is this just another bounce? Is the move from 72 back to 90 just a reflex rally before we roll over again? That's fair. For you, levels matter. If silver can hold the 88 to 90 zone midweek, that tells you the rebound has structure. It's not just a dead cat bounce, it's buyers stepping in with conviction. Watch that range. If it holds, the next test is 95 to 100. That's where you'll know if this is a recovery or just noise. But here's the thing. If you're trading this, you need to accept that volatility is the price of admission right now. Tight stops might save you on one move and shake you out right before the big one. You've got to decide if you're playing the swings or positioning for the larger move. Second, you're a long-term holder, and you're wondering if this volatility invalidates your thesis. You bought silver because you believed in the supply-demand story, the monetary uncertainty angle, the industrial necessity argument, and now you just watched 40% evaporate in days. Does that mean you were wrong? No, it doesn't. Volatility is the cost of admission in a market transitioning from financial asset to strategic input. This isn't the stock market. This isn't a tech stock with clear earnings and smooth price discovery. This is a commodity with a split personality, paper and physical, and when those two worlds collide, you get violent moves. If your thesis was based on long-term supply tightness, industrial growth, and monetary uncertainty, nothing about a leveraged futures unwind changes that. What changes is your emotional resilience. If you can't handle 40% drawdowns, silver's probably not for you. But if you understand why the volatility exists and you're positioned accordingly, this kind of shakeout is just part of the ride. Third, you're new, and you're thinking, how do I not get shaken out next time? How do I know when to hold and when to cut losses? The answer is simple but not easy. Watch what governments do, not what charts scream. Charts will terrify you. They'll make you think the world is ending. But if governments are hosting mineral summits, if manufacturers are still buying, if Shanghai's paying premiums, if mints are struggling to keep inventory, then the fundamentals haven't broken. The price action is noise. It's leverage. It's positioning. It's short-term emotion. Those things matter for timing, but they don't matter for direction. Your job is to understand the difference between mechanical selling and fundamental deterioration. One is temporary, one isn't. All three of you benefit from the same principle. Paper sets the pace short-term, but physical sets the destination. If you're trading, use that to time entries and exits. If you're holding, use that to stay calm during volatility. If you're new, use that to build conviction based on data, not emotion. So here's where I stand. I'm not chasing tops and I'm not panicking on engineered drops. I'm watching signals. Let me tell you what I'm personally watching. First, I'm watching whether silver holds that 88 to 90 range into midweek. If it does, that tells me buyers are absorbing supply and the bounce has legs. If it breaks lower, we might retest the mid-70s before finding a base. Second, I'm watching the 95 to 100 zone as a potential breakout level into Friday. If silver clears 100 with conviction, the move that follows could be significant because it would break the range and force short covering. Third, I'm watching premiums, especially out of Shanghai. As long as that $14 to $15 spread stays wide, pressure stays on Western paper markets. That premium is telling you that physical demand is real and it's not fading. Fourth, I'm monitoring policy developments. If the critical minerals ministerial results in concrete stockpiling commitments, or if Trump's strategic reserve proposal gains legislative traction, that shifts the narrative from speculative to strategic. And once an asset moves from the speculative column to the strategic column in the eyes of governments, the supply dynamics change permanently. Fifth, I'm keeping an eye on industrial demand data. Solar installations, EV production, defense spending. If those sectors stay strong or accelerate, silver's industrial floor rises, which means the downside risk shrinks even if the upside potential stays volatile. Based on my analysis, this crash wasn't random, it was mechanical. Futures positioning was stretched, margins tightened, leverage unwound, and cascades followed. That's textbook market mechanics. The fundamentals didn't break, they actually got louder. You've got governments convening summits on critical minerals. You've got strategic stockpile proposals moving forward. You've got physical premiums holding firm while paper crashed. You've got industrial demand that isn't discretionary, it's necessary. And you've got above-ground inventories that are historically tight relative to consumption. None of that changed during the drop from 121 to 72. What changed was who was holding leveraged futures contracts and how much pain they could tolerate. If history rhymes, and if silver continues to show the same pattern we saw in 2011 and 2020, the move that follows could be substantial. I'm not making a price prediction. I'm saying the pattern suggests that when paper liquidates hard while physical stays firm, the repricing that follows tends to favor physical holders. It doesn't happen on your timeline. It happens when supply visibly tightens and the market realizes paper contracts don't satisfy industrial demand or government stockpiles. Now, I'm not a financial advisor. This is not financial advice. Everything I've shared here is my analysis, my interpretation, my perspective. You need to do your own research. You need to verify the data I've referenced. You need to make your own decisions based on your own risk tolerance, your own timeline, and your own financial situation. Don't take my word for anything. Go look at Shanghai premiums yourself. Go read the press releases from the Critical Minerals Ministerial. Go check silver inventories at COMEX and LBMA. Go look at industrial demand forecasts. Build your own thesis. Make your own calls. I'm showing you how I'm watching this market. What you do with that information is entirely up to you. If you made it this far, you're thinking critically, and that mentality will serve you well. Most people chase headlines and panic on volatility. You're here, 4,000 words deep, learning how markets actually work. That puts you ahead. But being ahead only matters if you act on what you learn. If this analysis helped you see the structure behind the chaos, share it with someone who needs to hear it. If you want more breakdowns like this, subscribe so you don't miss the next one. And if you've got thoughts, questions, or your own observations on what's happening with silver right now, drop them in the comments. I read them. I learned from them. We're all trying to make sense of these markets together. Stay sharp out there. Think critically, verify data, and make your own decisions.